Welcome friends, in this video Onyxcoin Xcn came. Will the explosion come? We will analyze it. Don't forget to subscribe, like, and please watch to the end to understand. When we examine the chart carefully, we encounter a highly critical price zone. In technical analysis, this area is referred to as a reaction zone, a support level that has proven effective multiple times in the past and is closely watched by investors looking to take long positions. The fact that the price action is currently within this zone could be highly decisive for the market's future direction. Such areas often witness intense battles in terms of supply and demand. If the price reacts at this level as it has before, there is a high probability of an upward recovery move. The reason this area is defined as a reaction zone is that buyers have previously stepped in here and pushed the price higher. So this is not just a technical level, but also a psychological support line. When the price reaches this zone, it either breaks down under selling pressure or initiates a new upward trend with strong buying interest. In the current situation, the price being within this area and not yet showing a clear direction signals a critical phase that investors should closely monitor. When the price reaches such strong reaction zones, it typically follows one of several possible paths. The first is that it drops sharply into the area and then bounces upward as buyers step in, a classic bottom reversal signal that short-term traders look for. Another possibility is that the price consolidates sideways for a while, builds strength, and then chooses a direction. During this consolidation phase, volume and other technical indicators offer clues about the potential breakout direction. From a technical analysis perspective, for an area to be considered a reaction zone, the price must have previously paused, bounced, or reversed direction there multiple times. This means there is a high concentration of orders in this area. In other words, investors have seen this level as an opportunity and chosen to buy here. Now that the price has returned to this level, there's a strong possibility that similar behavior may occur again, especially if the price wicks into the zone and then forms strong bullish candlestick closes. This provides important confirmation that the scenario is playing out. Of course, there's no rule that every reaction zone will work forever. If no reaction occurs from this area, or if the price fails to hold and breaks downward, this support level could turn into resistance. In the next upward move, this area may then act as a new barrier where sellers emerge. Therefore, it's important not only to consider the what if there's a reaction scenario, but also to plan for what if there isn't. Risk management becomes even more critical in such cases. Another factor to consider in reaction zone analysis is timing and volume. When the price reaches this area, the structure of the candlesticks, for example, long wick bullish candles, can indicate aggressive buyer involvement. If this is supported by volume analysis, the reaction becomes much more reliable. However, if the reaction comes with low volume, it suggests that the move might be weak, and investors should proceed with caution. Some professional investors prefer not to enter positions at these support zones immediately, but instead wait for the price to bounce and then return to retest the same area. If this test is successful, meaning the price finds support again on the second touch and begins to rise, it confirms the level as a stronger support. This is known as a retest, and it is often considered a safer entry point. In conclusion, the price is currently trading in a critical reaction zone that has proven effective in the past. If a strong buying response emerges from here, it could signal not only a short-term correction, but also a potential trend reversal. That's why investors need to watch this area closely and analyze incoming price movements and technical indicators carefully. A reversal from this level would reflect not only the strength of buyers, but also a shift in overall market sentiment. However, relying solely on support zones is not enough. Other metrics must be considered as well. Keep watching. When we closely examine the chart, a significant situation from a previous time period stands out. While price movements were trending downward within a certain zone, there was a noticeable weakness in trading volume. In other words, although there was a downward momentum in price, we can see that there wasn't strong selling pressure in terms of volume to support this drop. In technical analysis, such situations are quite noteworthy because low volume declines often represent temporary profit-taking or market indecision rather than healthy selling pressure. And for exactly this reason, sharp and rapid upward moves can often follow such low volume pullbacks. Looking back at past chart movements, we can clearly observe a similar scenario. At that time, just like now, the price showed a gradual decline over a specific period with low volume. So while the price slowly trended downward on the chart, there was a visible weakness in trading volume. This indicated a phase where sellers were not strong and only weak hands were exiting the market. Immediately after this phase, an unexpected spike in volume occurred, which also pushed the price sharply upward. This sudden rise at the time can be explained by large players or institutional investors taking advantage of low prices. A similar scenario now seems like a strong possibility. Currently, similar technical data is forming. Over the past few days, the price has been showing a downward trend, but during this decline, trading volume has been noticeably low. The selling isn't aggressive. There are no large volume orders driving the move. This indicates that the decline is technically the result of weak selling pressure. The fact that volume is so subdued often points to pent-up energy in the market. Especially in the cryptocurrency markets, volume contraction is typically seen as a precursor to strong price movements. After such a contraction, either an upward breakout or a sharp downward move may occur. However, based on current formations and other technical indicators, an upward move appears more likely. At this point, the question arises, why do upward moves often follow low-volume declines? The answer is actually quite logical. Low-volume drops generally occur during periods when large investors are not actively participating in the market. The selling seen here is not the result of panic selling by major players, but rather stop-loss orders or minor profit-taking by retail investors. Large investors often view these periods as opportunities, because if the price has pulled back significantly without strong selling pressure, it can signal a potential buying opportunity. When big players step in, prices can spike upward quickly. From a technical analysis perspective, volume is one of the most important elements that determine the reliability of price movements. In other words, we interpret how healthy a rise or fall is by looking at volume. A low volume drop is generally considered an unconvincing move. Therefore, the current low volume decline can be interpreted as the calm before the storm. As trading volume in the market drops, it will eventually have to return to normal levels. And this return is usually volatile and sharp. If this move is upward, rapid and strong price increases may follow. This would be a volume-supported breakout, which can mark the beginning of a long-term trend reversal. For investors, these types of periods are often the hardest times to make decisions, because while the price appears to be falling, volume is very low. This creates uncertainty in the market. However, this uncertainty also signals opportunity. Looking at similar past examples, prices that fell on low volume were later broken to the upside with a sharp increase in volume. These scenarios are often considered accumulation phases. That is, large players slowly build positions at low price levels and then push the price upward. Another element to pay close attention to at this point is candlestick formations. If long wick candles begin forming during the low volume decline and the price consistently leaves lower shadows, this is a sign that buyers are starting to step in. Especially if green candles with volume follow these patterns, they are considered strong reversal signals. If such candles appear in the coming days, it could indicate the end of the low volume decline and the start of a new upward trend. In conclusion, although the current low volume downward movement in the market may appear negative on the surface, it contains highly critical signals from a technical analysis perspective. Especially considering similar past scenarios, such low volume pullbacks have often preceded sharp upward price moves. If this scenario plays out again, it would not be surprising to see a sudden and strong rally in the coming days. That's why it is crucial for investors to closely monitor both volume and upcoming candlestick patterns, because major breakouts usually come right after the quietest and lowest volume periods. Yes, friends, I hope you liked the video. If you subscribe to my channel and like the video, more videos will be coming. Be careful in your investments, analyze the risks correctly, and always take strategic steps. I will be with you with different analyses, investment opportunities, and technical information in my videos. I wish you all a lot of profit. See you soon.